Greetings, this is Jeff Scott. This is my weekend review. It is September 30th, 2018. As you can see in the lower left-hand corner, it is 2:44 p.m. Football games are on. My fantasy football scores are up, but there's no futures to talk about as of yet. I just entitled today On to October, sort of a wishy-washy, mean-nothing title because this is a month that sometimes is tough to predict, and we'll talk about that as we go forward. My name, again, is Jeffrey Scott, and my email is hgsi.gmail.com. For those who have not been to me before, I do this for free. I don't have anything to sell you except an occasional live meeting. I like to teach. I owe a lot of my money to what I learned from a guy named Ian Woodward, and it's sort of in deference to what he meant to me. I like to do this to help continue a lot of his words and wisdom. For those who are new, I use terms that I learned from Ian, which may not have much meaning to you. Over time, you'll learn what I do, and they're just different names for different things and momentum that I like to follow. So please don't be scared off by vocabulary. And if you drop me a note, I can always send you a guide to the vocabulary I use. I'm a physician, not a broker. I'm independent. So anything I talk about is for educational purposes only. I'm not trying to sell you any software products. I might support your use of some, like HGSI, through some of our discussions that we might have. And attorney involves risk, union loan are solely responsible. And if I talk about options, which is probably not the case today, I just suggest that you get educated, refer to the Options Industry Council website, and be careful because options can be risky if you don't know what you're doing. So I title my education, everything I do, to be your own guru. And it's a term that Ian used to use about telling people he's not a guru, he'll teach you to be your own. And I think that makes a lot of sense, and that's what I'm trying to do here. My meeting is November 28th. It is midweek on a Wednesday for a reason. It's $500. There's pre-seminar web videos that we'll do, live webinars. They're important because I'll make sure that you have a basic knowledge of options and my vocabulary so you can really gain from my meeting. There are post-seminar sessions to complete anything we don't get to, and also to review and answer your questions. And then during the seminar, I'll review basics of how I trade, my top-down approach, fantasy football zone, finding my A trade, some of the best trades I've taken this year. I gave people tandem at 6. Could have paid for a couple seminars with that one. How I manage the trades once I make them, how I incorporate options, and some of my favorite options trades look like. Earnings roulette. Last year I talked about Netflix and putting it all together. On the right are just a couple of comments. This is from NHI talking about a gain of 123,000. Took, I think, 3 weeks to get that with a risk of 35,000. That's a nice almost 4-to-1 return, 3.5 to 1. Here's another one from KH and talking about, did I really just make 391% since yesterday? These are real. I have the primary emails I present. I have others, although no one can guarantee you'll make returns like this. I will say that this is the only live meeting I will be doing probably through March. The planned Orange County meeting, for various reasons that are not driven by me, was canceled. What you'll get for your $500, besides what I think you'll agree to at the end, the hardest working educator you'll ever see who has no secondary gain, you'll get dinner on me Tuesday night, either on my lovely new yacht in the lower right-hand corner, or if the size is prohibitive or the weather looks bad, at a local steakhouse. During the meeting, I'll provide breakfast, lunch, and snacks. Each attendee will get screencast videos as well as PDFs. I've had a couple of people ask, could they sign up even if they don't come? Last year I ended up having so many of those that I did a screencast or live stream, rather, video. I'm not planning on the hassle of that this year. It took a lot of extra time and money. But if you're interested, you can register and participate on all the live, the online stuff. as well as get copies of all the presentations and the videos during the meeting and access to the indicators. I just won't be able to feed you. If you're interested, I need to know now. Those of you that said they're interested and haven't paid, it doesn't count until you pay. HGSI.com if you want to drop me an email. mdoc@mindspring.com, that's my PayPal. Those that stick around for Thursday, Friday, Saturday, and Sunday, which is the John Person meeting, you will get a $100 rebate from me once I verify registration, pay registration. Other thing is, I will probably have time on Tuesday for golf if people are interested in having playing some golf. I have a great club, but you'll have to pay for that on your own. I can't include that in the registration. As I said, I like to teach people to be their own guru. I learned Cancel Him, Improve by Morales and Catcher, Taken to the Computer, Made Better by Ian Woodward. Ron Brown was his partner. George Lee is a good buddy of me. I've learned a lot from him. I shared the stage with him. He's a great trader. Dan Tharp, the king of money management, Cigar from Superior Profit, who has created some indicators in TradeStation and Metastock that I actually incorporate in my daily trading. Some of them I have no idea what the math is behind them, but they work. And unfortunately, since I don't know what's behind them, you can't put them into HGSI or anything like that unless he wanted to do that. But I don't expect that to happen. And then John Person right here really helped me put it all together. He's got great indicators. He's got great education. He's just a trader, and he really taught me how to go from a stock picker to actually pick which one to buy and how to manage it once I bought it. I own a lot of programs. What I really need is TradeStation and Thinkorswim with the indicator sets that I use from Cigar, from John, and others. I need HGSI for my analytics. It's the best program I know, especially when I want it to be fast, reside on my computer. EdgeRater is a way to automate some of the things that I've done over the years. I appreciate that a lot. And I do believe in seasonality, although I think technicals and markets from seasonality. Not an advertisement because I don't get anything from it, but here's the website for HGSI. They have a free 30-day trial. There are ample educational material out there to help you learn what all those funny looking buttons do. I can help with that as well. And investing strategies under that are a number of free videos from Ron, myself, and others, including Gil Morales. Now, to me, the most important aspect of anything I'm going to do is dependent upon what is the market doing. And are we in an uptrend, which is great, driving prices higher? Are we in a sell-off? Are we in a period of uncertainty or ambivalence? As I've said over and over again, it's kind of like we've rotated this so that we're going up. But every time it looks like we break out, we hit resistance, then we sell off into support, and just like as soon as it looks like we're going to have a big pullback, we take another move up. Now, it's been an interesting market, in my perspective, because even though the market's going higher, there's a lot of weakness. This is sort of the generals are leading, but the privates are falling back. So I said October can go both ways. Historically, October is a pretty darn strong month. The problem with October is that some of the biggest corrections have occurred in October. More about that to follow. So I have smaller positions and sold premium, but I've also still have a very long portfolio. I have a little bit of protection on, which is pretty typical for me. I can be net short, I could be net long, and then I can have variations of such by bond contra ETFs and options on futures, etc. Portfolio. So I always start with a sector review. This is a little different this time, and let me bring it up in TradeStation. It might be easier to see. And what I've done is I've now looked at the various sectors. Here's materials, energy, financials, industrials, technology, staples, discretionary, utilities, healthcare, communications, which is a new one in real estate. So when you look through, Friday looks like a pretty powerful day, a pretty strong day. But there's clearly some areas of weakness in materials. Energy was a little weaker, and financials have been just plain old weak. Technology, although it looks strong, I can't say that semiconductors are super strong right now. And if semis are not strong and the financials are weak, where's leadership going to come from? Right now, it's some of those social media stocks, besides Facebook. Real estate's been strong despite high interest rates or higher interest rates. And healthcare, especially small biotech and utilities, have been leading. Now, the next thing I usually do is get a sense of the markets, just popping into Thinkorswim. These should be dailies, and they are. Let's open that up, make it easier for you to see. Hoping to make it easier for you to see. There we go. So if we look at the E-minis, we broke out of prior highs, came back and retested at the 17-day moving average, sort of a gravestone doji. We've tested that level now 3 days in a row. I'll be looking for this to trade up this week, although a break below this level would make me nervous and would not surprise me to see us come back 30 handles down to the 50-day moving average. So I think this is a bullish pullback, but I would look for the market to take out the high before I start adding a lot to my positions, the high on Friday. If I look at the NASDAQ touched the 50 for multiple days. It broke out. It looks to me like it wants to go higher. It's just below the last closing high at 76.97. I think it's about 9 points behind that. That looks like it wants to go higher. The Dow, in a pullback mode, but pulled back to the 17-day moving average has held. And all of these indexes have finally taken out their prior highs for the closing highs in the year. And it took almost a whole year to get back from where they were in January for the S&P and the Dow. So when I look at this, yes, it's a pullback. It's pulled back to support. Looks to me like it's ready to bounce and go higher. And all these ideas only matter until the futures come out, and then certainly 9:30 in the morning. The Russell, not so good. The Russell has broken down below the 50. Now, we had a positive day on Friday, despite the market itself, and the week being relatively mixed. The Dow and the S&P down, the NASDAQ up a little bit. Now, the question is the Russell going to get back above that 50 quickly, or are we going into a longer period of decline? Now, the Russell is knifed below the 50 multiple times and got back, but it's also pulled back a couple times this year to the 200-day moving average. That 200-day moving average would be about 4 or 5% drop from here, so not gigantic, but you probably feel more of it in your portfolio. So I'm going to watch that. That's clearly the weakest. The VIX, with the market strong, has been weak, sitting on top of the 50, unable to get into above the 200. And the dollar bounced a little bit after the Fed tightening. Now, I always like to switch back to the weeklies and to take a look at the dollar on the longer time frame, because the dollar, to me, has not looked as bullish on the longer time frames, where you could see we're more of a downtrend and a retracement and continue to fail at that 200 weekly moving average. And even with the pullback in the Russell, you can see that all my major indices have been in nice uptrends for quite some time. And then sometimes I'll look at Genesis, sometimes being every 10 minutes when I'm sitting at home. And what you could see if you look at E-minis, NASDAQ futures, Russell futures, NYSE, and then the Dow futures, and you look at daily, weekly, and monthly, the monthlies say it all. They're nice uptrends. The weeklies look good. The dailies are a little choppy with the recent pullbacks, but still overly a strong market. Now, rates really didn't do much this week, up and down, and despite the Fed raising, they actually lowered a few pennies on the week. But they are at the higher end of their range going back to 2014. So higher rates will be good for banks, and banks were certainly weak on this review this week. But interestingly, higher rates are supposed to be bad for REITs and utilities, and they're strong right now. And maybe that's because their defensive plays, and they're looking at the market implications of potential other negative events. Falling yield curve, they make a lot of this, and this is where it's at. This is where it gets to zero. This is the S&P 500. As I interpret the falling yield curve, it only becomes a problem when they start to tighten, and that's when we see in the past they tighten here, they start to raise rates, and the S&P falls. They start to raise rates above zero, and the S&P falls. They haven't started to raise rates. Well, they've raised them, but they haven't reversed the yield curve. So again, let me say that again because I don't think that came out great. The falling yield curve doesn't cause the S&P to falter. When that yield curve goes back up is when the S&P drops. Falling yield curve did not hurt the S&P. They continued to go higher. It's when the yield curve went back up is when the S&P started to drop. So clearly it's a predecessor to a market pulling back, and certainly something to keep an eye out on as we go forward. AD lines, you can probably see it better here. Near highs and the AD line on the NYSE, and then my diamonds, Qs, spiders, and IWM all turned off a little bit. And with rising dollar and rising rates, the price of bonds came down some this week as well. Breadth, actually stocks above the 200 and above the 40 dropped a fair amount, but still not oversold. And the 3-week new high, new low ratio, which is my really accurate short-term movement indicator, is down quite a bit, but it's not anywhere near an extreme. It's where an extreme that it tells me to be concerned or get excited. The McClellan is bothersome. Stocks go higher on the daily, and we can't break the zero line on either the McClellan oscillator or the summation index, and we have clear-cut divergences here, which are negative. Here's the weekly. We're making higher highs, and we can't make higher highs here. So this is stuff that might be concerning and might be indicative of some deeper underlying weakness and potential risk. The buckets. This takes the 1,500 stocks in the S&P 1,500 as I defined in July. I do an update every quarter, so I'll update the stocks. So it's probably not that much different right now. 58% of the stocks in the S&P 1,500 are below the midline of their Bollinger Bands. That's a little bit bearish, but not that far out of neutral. I have 9% of stocks below their Bollinger Bands. I've got 4 above. Again, sort of a shift to the left here, a little bit more bearish feel, but not to the point where I would assume and expect an imminent reversal in the market. Hindenburg Omens eased up a little bit at the end of the week, mostly because there's not enough new highs to trigger them. As I said before, this is a confusing market, and a lot of people have commented that with the sheer number of Hindenburg Omen signals that we've seen, that the market should be a big risk and should be pulling back. And it may be that some of this is simply an issue related to there is weakness in the market, but the indices are being kept afloat by some of the generals. And so we'll look at some of that. Market tone. This is over here is called the Woody indicator. And we could see mostly neutral, although there are some bearish signals coming in with the Russell and semiconductors. Sector strength. I guess I got to change that. Sorry, I missed that one. Weakens. and you've got more sectors that are showing weakness than we did a week ago, and you could see the multiple red areas here, which is concerning. So a weak market or a market that has weakness, maybe two separate terms. Now, I looked at October seasonality, and I looked back 20 years at the major indexes. You can see the percent of time on the right in October, from the beginning to the end. This is clearly, obviously, in Edge Rater, that except for the volatility index, and every index is positive more often than it's negative. Okay, that's bullish. You can see that the NYSE is up to 75% of the time, average of 2%. Transport's up 4%. The industrial's up 2%. The NASDAQ 100 is up 70% of the time, up 4%. So I would consider that to be evidence, as I mentioned, that the market is often strong in the month of October. Contrast that with over here with September, and you don't see anything above 50% except for the Amex and utilities. And the utilities, if anything, would be contraindication, they'd be contrary, probably the word I would use. What about sector strength? And you could see broker dealers, aerospace engineering, insurance, financials, technology. So we're going to have to see some kind of a turnaround, because clearly right now, I don't think anybody sees strength in semis and financials, but maybe that's about to change. I look at some indicators of market strength and weakness. These are the canaries. It's a mixed bag. Tesla will probably bounce on Monday. Elon settled. It took like 2 days for him to settle with the SEC. He's going to give up his chairman role, and I think it cost him some money, but he can stay at Tesla, so that'll probably cause a rebound. So that confusion and concerns might be gone. Apple and Amazon and Netflix are performing well. Facebook, Baidu, Bookings, Alphabet, not so well. So you have a mixture of good and bad. And what would you see for that? You're just oscillating around the 50, but I don't lose sight of the fact we're getting lower highs. So maybe the day of the canaries is near the end. Now, not long ago, on September 2nd, so almost a month ago, I put together an index of summer leaders. And I'll refer back to my video on that date. And the point of that was to put together a list of leading stocks with the expectations that leaders lead. And if the marketplace was going to roll over, that the leaders might actually break first. So what we have here is a group of leaders that did sell off hard maybe 10 days ago, but they've regained their moving averages. Their weekly bond goes still positive. It's still in an uptrend, and that's sort of my early warning signal. And I think I actually did a webinar around this time and talked about how I would approach this if this broke down. Because in the past, these indexes that Ian would create, called the E-index, were just great at letting us identify where market reversals occurred. Know your news and earnings. This comes from Econo Day. Friday, September, this is last week, so let me stop here for a second. All right, sorry about that. Here's Monday's calendar. And what do you see on this calendar? The first thing is it's a new month, so we got the employment numbers coming on October 5th. That'll be market moving. We've got a Fed head speaking that afternoon. Jobless claims on Thursday. We've got Jerome Powell speaking on the 2nd. That can move the market. We've got some manufacturing on Monday. I'll put this as a medium week for data. I'm going to kill that thing and just make this one bigger. All right. As I say, it's really bad if you don't know when your earnings dates are. This is a quiet week for earnings. Quiet unless you own Stitch, which is a big growth stock. Not a big one. Lennar Builder. Pier 1 Imports, Constellation Brands, Costco. So there are a number of things reporting as the earnings season is coming to an end. And just make sure you know when your earnings dates are, because if you don't, you'll get burned. So we lived into end of September with the NASDAQ and growth leading certainly the past week, but it's flip-flopping. 1 week growth, 1 week not growth. Despite walls of worry, the market finishes a very strong third quarter. For the quarter, the S&P added 7.2, the Dow 9, and the NASDAQ 7%. Saying that, remember the Dow and the S&P are just back to where they peaked at in January. News continues to cause daily swings and averages continue to creep higher. I doubt this will be any different. We've got the Kavanaugh versus Ford, the Russia versus Trump, trade wars, Trump versus OPEC, midterm elections, a lot of things that are going to clutter up the mind. Seasonality turns positive, as I said before. Many of the largest market reversals, 1987, for example, have occurred in October. And in the setting of midterm elections, this negativity has even worsened. Yet we have a strong economy, reasonable rates, no recession. So as of today, at this time, it's easy for me to say the bulls remain in control. So let's go on to my usual top-down review. Close off my presentation. I always spend a lot of time on the markets, and sometimes I get criticism for that. The first thing is you get what you pay for. I do this for free, so I'm going to do what I want to do, which sounds obnoxious, and I don't mean it to be that way. But more importantly, I'm a top-down guy, and I need to know what the market's doing, and more importantly, what industry groups and what sectors are leading before I'm really going to make any decisions as to how I'm going to put my money at risk. And, trading is not without risk, and, you should only trade, certainly speculate on money you can afford to lose. So this is Major Markets Plus. It's 24 different indices or ETFs representing indices. And I rank it by top-down view, which is mostly gives the weight on Friday, some for the last week, and just a teeny bit for the last 3 weeks. And what do I see with my analysis here? Silver and oil up at the top. Well, that's bizarre. Silver and gold have been lagging for so long. We'll have to look at gold. And the S&P 500 and the Russell, the semis on the bottom. So clearly a market where the typical stocks are not as strong as perhaps the indices are looking. So let's take a look at some of these. Let's start with the S&P 500. And let's go to, I will leave this view on here. So the S&P 500, remember I said it's kind of every time it runs up, it pulls back, runs up, it pulls back. Now the channel is getting narrower and narrower. It's now bouncing between the upper trend line and the 17-day moving average. But we are pulling back to that level that we bounced from. So as I said earlier, it wouldn't surprise me to see the S&P at least bounce at the beginning of the week. When we are on Sunday and we're at the top of the range, I'm going to say it the other way. Last week, we were at the top of the range. So the S&P 500, I still would argue, can go higher. The Dow Jones Industrial Average took out its prior highs, pulled back to the 17, bounced. Looks like it might be willing to retest those prior highs. Now, let's also say the other part, which is there is on the S&P, it's on oil, I'm sorry. I go back to that S&P 500. I'm not bullish and forget. If I break down below this level here, then I got to be worried we're going to go down to 2862, and that's 50 points in the S&P 500. And that will impact on your portfolio. So my gut is we go higher, but I'm going to be watching the market and making moves based on what we really do. Same thing on the Dow. Yes, I think it's going to go higher and at least retest and hopefully break out of that recent high. But if we broke down from here and broke below the 17, I've got to be concerned it's going to go down to the 50 or maybe worse, the 200, and how that might impact on my portfolio. If I look at the NASDAQ, at the lower end of its range, so it's easy when I'm hitting this level here and I probably see some overextension on some of my other stuff, I would expect and be concerned about the market pulling back. When I'm coming off the lower boundary, I'm expecting the market to go higher. I expect it to go higher this week. But if it broke below this 50-day moving average, that would be very bad. And using the IWM for the Russell, it has broken below this 50. So now the issue is going to be, is the high road, I'm going to go out to new highs quickly. The middle road, I'll get back above the 50 and go sideways. Or is the low road scenario going to be able to go back and test that 200? That's a big drop. May not be a big drop in points, but I would suspect that if we go down and retest that 200, that this market's in trouble. Let's take a look at the dollar. Yeah, but first let's look at biotech, because I'm going to come back to biotech later. Biotech here, which is the biotech generals, I think, more so than the small stocks, really looks good. And it looks like it's ready to start taking off to new highs. It's got some trend line support down here. I think biotech looks interesting here, and I do, specifically Biogen and Regeneron and maybe Celgene and Gilead. But if I look at the LABU, which has a wider range of stocks, and they include more of the small stocks, doesn't look as good, does it? It's actually sitting on support, so maybe that's an even better reason to buy. That's just something that I thought was an anomaly, but I thought it was an important anomaly. We go back here to Major Markets Plus. And the NASDAQ Biotech, which we just looked at, we need to look at that again. Let's go to the dollar. So the dollar I showed you is in a longer term downtrend, but on a short term it's been moving up. It did spike above the 50 on Friday on lots of volume after the Fed, but it did come down from the open. Volatility, as I mentioned, is quite low. Gold had a big move on Friday. I guess percentage-wise it was up over 0.5%, but gold is in a very bearish position right now and continues to drop. And it's something that we probably don't want to be overlong in until at least breaks above the 50 and holds. Silver, which is up near the top, which has more industrial uses, and perhaps it's a little different, has broken above a couple of moving averages, but still has to get above that 50 to make me a believer. So I start with the industry, with the major markets, and I am a little bit bullish for this week. With all the caveats, we'll see what the market looks like in the morning, and we'll also obviously are aware that news is bad, and we might expect additional news episodes this week. Once I've done that, I want to go into industry groups. At the warehouse view, they'll pop over here. And as you can see, I've got 174 industry groups. And I use the force-day index 2 days to show me momentum. So this is momentum up. I've got 52 groups. Momentum down, I have only 8 groups. So internet, media, base, internet, airlines, infrastructure, wealth, oils. Those were a lot of growth names that were actually negative this week. But let's take a look at some of the positives. So I'm not going to go through all 10 groups today. I'm tired. But I will go through the first couple, and then I want to look at some selected stocks. Right-click on infrastructure, construction. The stocks come up to the top. I only usually care about what's stronger than the index. Here's a stock that's up 122% in 5 days. It's an inexpensive Indian fund. And those who've been to my webinars know I have a whole collection, or webinars, education programs, of stocks that go up like this on very wicked. Here's the bar up there. We make it a little wider. All right, this was up on 104 million shares on a stock that normally trades 10 million shares. So on 10 times regular volume, the stock went through the roof. I have a hard time playing these because what happens in my usual experience is they go higher and higher and then they hit an air pocket and they come down hard. This looks a lot like Plug did a couple of years ago, Lakeland Industries. Um, so I'm probably going to sit this one out, but I just thought I'd show it to you because it certainly is impressive. For those that are new, remember, I don't want to scare you, but the bottom are what we call kahunas. Those are momentum. Green, blue is up, red is down. In here, where my arrowhead is, are pocket pivots. There are none here. This is on balance volume with the moving average. And then we have mobile breakouts and breakdowns, a squeeze, aka John Carter, viable gap ups, which we had on Friday, Morales and Catcher, high jump bar that shows extension, and then bongos and forced indicators and accumulation distribution. What you need to know is green is good and red is bad, and green and blue are treated the same. So this is very positive looking, except it's really ran too fast, too far, and they don't always end well, so I would stay away. Right click, back, and then I want to look at application software, see what they have. And BlackBerry is so funny. I should have went super long because my son, who's discovered options but has not yet discovered education, called me up all excited because we will buy some cheap puts on BlackBerry before earnings. If there ever was a contrarian indicator, it's that. So I should have known that BlackBerry is going to have great earnings, and they did. I look at this, and I still have a hard time buying it. I mean, clearly it's been in a pretty wicked downtrend for as long as I can remember. No one, I don't know if anybody has a BlackBerry anymore. But on the other hand, I start looking at trend lines. It broke through a downtrending trend line, and that may actually make it attractive here. So something to look at. It also had a huge move in one day, and sometimes stocks reverse or pull back. So 31 million shares traded up 11.5%. Should have bought it when my son was shorting it. Into it, a beautiful tight lower left, upper right pattern. I think this is in my summer solstice group. Mobile breakout from a squeeze here, a kahuna. It's hard for me to buy this stock. It's extended. It's had a huge move, but I can't argue that this is not one of the leaders right now. Electronic Arts, down in its, below the 200. I pass on that, but that might be getting ready to run. NetEase, the same. Activision, pull back, bounced off the 200, retested, and now at all-time highs. Not done well historically with gaming stocks, so I would probably pass. Viva, one of the strongest stocks in the market. It's expensive. It's got great growth rates, but a super high multiple. It looks to me like it's ready to run again. It's coming out mobile breakout from a squeeze, breaking out from a high base with a kahuna. Earnings are not out to December, so that may mitigate some of the risk. Take Two, it's another gaming stock. So there's a number of things to like on the application software group. Third group is exploration and production. There's no question that this has been one of the strong groups. We talked about Marathon as one of my top choices last week. And you can see why. It had base for a while, 1, 2, 3, 4. And last week, it had just broke through its PSAR dot, and it continued higher. Great earnings per share growth compared to multiple, pays a teeny weeny dividend. Occidental, a pretty pure play oil company, pull back to support, moving higher. Finding these that are good buy points may be tough. Here's one that is WPX breaking out here. California Resources, this one's had a huge run. 15 to 48 in 4 months. That's pretty impressive, coming out of a sort of a cup and a handle and a breakout. That's interesting looking, although it doesn't make any money. Whiting Petroleum is one I've also liked. Shallow pullback breaking out here. So I think there's a lot to like in oil exploration and production. And most of what I'm hearing suggests oil's going higher. REITs, with interest rates holding steady, some of the REITs jump back into the picture. We'll look at a couple of them. REITs, I usually don't do options with because REITs pay nice dividends, and I don't want to miss out on dividends, especially if the stock value drops after dividend distribution. Crown Castle International, great earnings per share growth, pays a 3.8% dividend, pulling back to the 200 and moving up. A breakout above the 50, that might be interesting. Prologis, is it an exciting stock? No, pays a 2.8%, pretty steady Eddie. Essex Property Trust in an uptrend, pull back to the 50. Kahuna Pocket Pivot Mobile breakout from a squeeze after green candle low. That looks interesting as well. So pick your poison on them. I'll show you some of my picks when I show you my buy list. And I typically would go through the top 10 lists. And we're going to stop on this one. And then I had some other things that I wanted to look at today. Specialty Pharma. Amarin had some interesting data in relation to fish oil. That's not what I wanted, but that one is. And you could see how it had just a big move. Now, I will give my son credit. This is why options are dangerous. My son bought some calls on Amarin, $15 calls. He paid $3 for them. They went up $2 immediately, so he's got a pretty huge return. He called me up, and I made a comment that why don't you sell your options and take your profits? And God love him, he picked a good stock, but he didn't realize you could sell your option anytime. You didn't have to wait to expiration. So education is important. We'll see if he listens to that. But Amarin continues to go higher. And what I suggested, when I see something like this, I take half off. And that way I won't lose, raise my stops above break even, and let the stock run on the remainder. Hopefully that's what he'll do. GW Pharma, this is probably the leader of the marijuana drug stocks. It has a drug approved worldwide for epilepsy and just got some recent information in the U.S. I think the FDA gave it an approval and are allowing it to be marketed, so that's a big deal there. Neurocrine Biosciences, beautiful uptrend. Stock went from 50 to 126. Sometimes you trade too short and you miss out. I had the stock and made money on it, but got out of it when it violated the 50. And then I broke a rule, which was I should have gotten back in when it came back up, but I sort of moved on. So there's something to like in specialty pharma. Now, I mentioned that the markets are not as strong as the indexes are. Let me show you what I'm talking about. Let's look at, put this into all securities. We'll look at a couple. If this market is to take off, I would expect, that's not good. It should be led by technology, which the Qs have been super strong. But within technology, I have semiconductors, not nearly as strong. Look at the Qs. Clear, tight, lower left, upper right. And then let's look at semiconductors. I think you need semiconductors to get back in the game if you want to go see new highs. So let's look at what's working. Amazon, not the world's best buy point. That would have been when it pulled back to the 50 here. If you had lots of capital and were willing to risk what in the past have been pretty significant pullbacks. Nothing bad looking there. Looks like it wants to go higher, but knowing the stock, it's going to go up and down until earnings. That looks pretty good. How about Netflix? Obviously, Netflix got clobbered at one point. On an earnings miss right here. But after pulling back hard, it's actually got back to over 370. It's got good earnings growth. Earnings are not out for a couple of weeks. Netflix looks to me like it wants to put an assault on old highs. That looks pretty good. How about the poster child of good-looking stocks? Intuitive Surgical. Looks like the cues, lower left, upper right. Here's been one of my favorites, although it's pulled back of late, Tandem. From 6 to 50. Pulled back out of when they had a lockup ended on a number of shares, but it's rebounded. We'll see what it does. All right. What's financials? You'd expect financials to be necessary if we're going to go out to new highs. XLF is breaking down. Go back 2 weeks, I was talking about how it was breaking out. But even then, I said, but banks look weak. Bank of America, breaking down. JP Morgan, breaking down. Wells Fargo, broken down. Citigroup, pull back to the 50. Goldman Sachs, breaking down. Morgan Stanley, breaking down. This is worrisome to me. The banks look horrible. Now, you got things like Progressive Software. We don't want that one. PGR. Here's an insurance company, Progressive Corp. That looks pretty good. Aflac looks pretty good. All states pull back a little bit, but insurers look good, but finances are weak. And how about one of the big winners of the last couple of years, Alibaba? Looks pretty weak, doesn't it? In fact, talk about stocks that you might want to have shorted. I mean, you have a stock that every time it runs up and touches that trend line, you want to short it. This is in a downtrend. How about Baidu? A similar story. If anything, this is a short. Probably not a long. So Chinese stocks are worrisome, even the big ones. Weibo used to make money on this all the time. It's been in a downtrend now for quite some time, along that 50-day moving average. BZUN. Also in a downtrend. So the point is, if semiconductors, let's go back and look at them, SMH. So let's look at Micron. Downtrend, broken down. Let's look at Intel. Broken down, although a good day on Friday. Let's look at Broadcom. Better, broke above the 200. Let's look at Skyworks. Broken down. This stock market is being held by Amazon, Apple, Intuitive Surgical, Line Technology, and I think the reason why the Hindenburgs are real is that underneath the indexes, there's a lot of weakness. So be careful. It is not a great market right now. Now, I did my usual, which is I went through a large list of stocks, and these are the ones that I came up with as my buy list. Now, and I'll talk about how I've been doing lately as well. Let's quickly go through my buy watch list. I'll tell you what I liked about them and how I might play them if appropriate. Just because I have a buy list does not mean I'm buying everything on this list. So before I do that, let's just take a look at the list. And let's break it out by sectors. This is a small list. I got a bunch of REITs that looked interesting to me. And dividend payers, and clearly they are a defensive play. I saw some exploration stocks, and then healthcare facilities. They're kind of REITs for healthcare, or these are, in this case, they're hospitals. Managed care, so there's some healthcare there. In fact, let me go back to my charting. Healthcare has been one of the stronger plays. That's a beautiful chart, but it's not biotech, but it is things like Centene, CNC, which is one of my buy watch stocks. Here's a great uptrend, strong industry group. On Friday, had a mobile breakout from a squeeze, a PSAR reversal, and 2 kahunas in a row. This is one of the stocks that I'll be looking to buy this week. Now, when I say I'm going to buy something, let me just tell you what it really means. It means it's going to go into a watch list. And that watch list is going to end up in a radar screen. And in that radar screen, I'm going to be monitoring these stocks on a bigger monitor so I can see all the way across for some of Cigar's indicators, for John Person's high closed dojis, low closed dojis, and then over here looking at things like when are their earnings, squeezes, pocket pivots, Bible gap ups, and mobile breakout squeezes. And I'm going to look for evidence in real time that something is happening with my stock. In addition to that, I'm going to put in with one of the services I use an alert. So I look at this and I see, my God, it's had 3 kahunas in a row, a mobile breakout and squeeze. I want to buy Centene. So I look at Centene, it's $143 stock. I have a lot of money, but I'm not going to buy a zillion shares of Centene. So if that's the case, what might I do? I will open up this window here, which gives me the numbers. I will also open up the drawing. So the first thing is, I'm only interested, and ignore this blue dot, it's meaningless. It just tells me what the projected next earnings are, which are not to the 23rd. The high of the day was 145.04, closed at 144.78. So I don't want to buy this till it takes out the high. So I'm going to put a buy stop with my broker or an alert at 145.05. All right. So I'm only interested if I get above 145.05. I'm going to put my stop. I could put it below the lowest of the last 4 days, which would have been this guy here, which would have been 142.42. But I'm going to put my stop, rather than that, I'm going to put my stop somewhere underneath the 50-day moving average, which is 140.92. I'm going to put my stop at 138. Say 138. And I'm going to draw a red line there. So now I've established the parameters. That's not what I wanted. Sorry about that. Now I've established the parameters of where I'd be interested in buying and selling that stock. And now I'm looking, I've got about $5, $4.50 in it. Actually, it should be lower at 138, but I've got $7 of risk in a $145 stock. That means I'm risking about 5%. I'm comfortable with that. And I would put in a potential order, whether I was buying stock or options, to take the trade if it takes out my buy stop. If it breaks down below the 50 or it doesn't trade above my buy stop, I don't want to be in there. Now, someone could say I should have put it closer to the close, not the high of the day. And again, this is higher than it should be, and that's also higher than it should be if they're in the right position. So I will go through each of these stocks, and I will work up each one as to where my buy stop is, where my drop dead stop is if I made a mistake, and then based upon position size and money management, how many shares I can buy. So CNC was one of my favorites of the weekend. So let's look at what I picked, and we'll rank them on just a regular combo filter by industry group. And let's take a look at the first one, and I'll tell you what I liked about it. All right, where's my chart? Here it is. So what do I like about this chart, and what am I going to do with it? You can probably tell me what I like. Clear-cut uptrend, pull back to the 50, mobile breakout from a squeeze, a kahuna, stock has earnings per share growth, pays a small dividend. I like ADM. Again, I would buy it probably above the high of the day and put my sell stop probably below the lowest day of the last 4. Renewable energy, don't know anything about this company, but I love the pattern of a high base and a breakout with the multiple kahunas. Continental Resources is one of my favorite all-time energy stocks. I've been in and out of it for some time. And you could see on the weekly a similar pattern where it's got a base and looks like it's breaking out and going higher. And it too, like many of these, makes good money. Energen, there may be a takeout on this one, but again, look at the earnings per share growth. This one's already run, perhaps too far, and I'd look to buy that on a pullback. Marathon Oil, similar story, been better to buy it the week before, but it still looks like it's one of the leaders going forward. Whiting Petroleum, maybe a little bit better buy point, similar pattern. WPX, we looked at it before, is already broken out. Look for a pullback. Here is a metal stock, industrial machine goods. It's a loose pattern. It's not a great pattern. I like those tight, like you saw the Intuitive Surgical in the line. But a pullback to the 50, a big move on a mobile breakout from a squeeze, good earnings per share growth, high demand. This is probably the one that moves the most. I'm interested in that one. What is the volume on that? That's the only concern. 511,000 shares. HCA Holdings will be the first of a couple of hospitals, high base breakout. Universal Health Services. Oh. I just love when Siri answers me when I don't want to talk to her. Pull back towards the 50, pocket pivot, kahuna, mobile breakout from a squeeze. This is Universal Health Services. R1 RCM, it's a billing collecting company in healthcare. Actually a competitor of mine. Pull back towards the 50, mobile breakout from a squeeze and a kahuna. I don't like its fundies. Wisdom Tree Investments, this is sort of a bottom fishing buy. This is a stock, look at the earnings per share growth. And when I looked at this, my John Person signals, just for an example. What I saw, and of course, I have to set this up to work. All right, the other green. This is monthly, weekly, daily. I see some oversold on the circles, some MACD diversions on the little green, a new person buy signal, a high close doji. It's in a weekly buy signal, volume is strong, coming out of a squeeze. I don't know if I can get it to run more than 9.5 or 10. There's some resistance there, but that's still a 15% move. So I may play a little bit of wisdom ETF, but again, it's a bottom fish, and my target would not be more than that 200-day moving average. Centene, I already mentioned, like that one a lot. Here's a biotech stock. It had a Bible gap up on Wednesday. It's a cheap stock, or Tuesday on Wednesday. Worth a little bit of research. Don't know much about it. Here is an MLP, and the reason why I was interested here was a 7.5% dividend pullback moving up. If it can break above the 50, I might have some interest. Ascent Group, this is a mortgage finance play. I like the pullback with a pocket pivot kahuna in a squeeze. Funko, don't know anything about this company except the name is cool. Had a big run up, pulled back to the 50. It looks like it wants to move. I don't see it in my momentum signals or a lot of volume on Friday, so I would wait to see that, but it's going to be on my watch list. Old Republic is an insurance play, a pullback, looking for some momentum there, 3.5% dividend. Progressive is an insurance play. Radian is an insurance play, sideways. A couple pocket pivots, a kahuna will break up from the squeeze. I am totally a broken record when it comes to these things. I take the same trades over and over and over again. Park Hotels, a REIT, 5.2% dividend sitting on the 50. Global Net Lease, a REIT, pays a 10.2% dividend. Then a couple of healthcare REITs, HCP, sitting on the 50 with mobile breakout, with a kahuna and a pocket pivot, 5.6% dividend. Matt Cali, another REIT. This one looks even better. Multiple kahunas, pocket pivots, and a mobile breakout, pays 3.8%. Here's the other medical one, Medical Property Trust. Again, mobile breakout, pocket pivot, kahuna, 6.7%. Sabra, multiple different types, but pull back to the 50 in a squeeze with a pocket pivot and a kahuna and a 7.8% dividend. And then in the semis, this one looked interesting. A cheap semi, Lattice Semiconductors, got good earnings per share growth. Pull back to the 50. I like to see some momentum. And then probably the best of the semis, and why I think semis might be turning around, is take a look at what we have here with NVIDIA. Medium tightness. Obviously, it's been a big leader over a prolonged period of time. Let's take a look at the weekly. You can see the big run up. Pull back on the weekly. Pocket pivot, kahuna, mobile breakout from a squeeze. That's interesting. But also, what I thought was interesting was this is how it's taking off here, breaking out in the daily as well. So I do like NVIDIA here. I'll play it with options. It's an expensive stock. And those were the stocks that I am going to be following on Monday. I supplement that with a number of other programs and look for things breaking out on volume, pre-market movers, etc. But most of my trades will come from the things that I showed you tonight, and many of them will be trades that I enter. I don't sell you anything. I'm not an author. I'm just some schmo that's been trading for a long time and have learned a few things that I like to help other people with. But you have to ask, what kind of performance does this person do, and why am I listening to them? I start every year in this account with a $2.5 million basis. I've now bought 2 boats this year with the money in there. But more importantly, I want you to see that I've had an overall P&L year to date of about 1.6 million, 1.57 million. That was off a 2.5 million basis. So in this larger account, which I trade predominantly options, I'm up somewhere about 62% on the year. The other account that I trade is at Schwab. This is a dinky little account. I started the year with 59,000. All right, I've taken out a significant amount of money from that. The value today is 163. despite the fact I've taken money out. And because of a huge return on Tandem, Cleveland Cliffs, and ConocoPhillips, this account's up 268% in the last year. My average in the last 3 months in this account is up 41.5%. Those are the two accounts I trade on my own. The rest of my money I give to other people because I have a day job. But the point I want to make is this. I don't have any sexy indicators. I don't put on webinars all the time. I don't have a trading room. I don't have a service. I just like to read. I learned from some very smart people, and I like to give back. I've heard comments, people say it's not as easy as I show it is, and I laugh because not everything I do goes up. I probably have more losing trades than winning trades. It's knowing what to buy, when to buy them, how to manage them, when to take losses, and those who've been watching me for a while know that I'm pretty good at doing this on a regular basis. So love to have you come to my live meeting. Let's just finish up with that. I guarantee that you'll leave that meeting knowing a lot more than when you got there. You'll also gain a few pounds probably as well. But the most important thing that I just want to reiterate, you have to become your own guru. Nobody is going to do it for you. And everybody that wants to take your money, in my opinion, not everybody, because there are people like John that I feel differently about, but so many people want to sell you something. I want to make you a better trader. $500, November 28th. I look forward to seeing you there. Thank you and goodbye.